Hello Canadians, I'm your mentor Bakr Bhatti. In this video I'm going to discuss a very important concept that may be of interest to majority of the Canadians, and it is the concept of principal residence and the effect of selling a principal residence on your capital gains tax. Here is the disclaimer that whatever I'm going to share with you in this video, it's only for educational purposes. However, if you need any specific advice on tax and accounting matters, you can always call us at 289-952-3494, or else you can send us an email at pascat2017@gmail.com. In this presentation, I'm going to discuss 4 distinct topics. First is the types of principal residences that are approved under the Canadian tax laws. Then there are important conditions that must be met if you want to claim the benefit of disposal of a principal residence to avoid capital gains tax. Then there are certain general rules and special rules that we'll also look into in this session. So what are the types of principal residences? It could be anything. For example, a house, a cottage, a condominium, apartment, trailer, mobile home, or a houseboat. Now, which property qualifies as principal residence? There are 4 conditions that must be met. What these conditions are? First of all, there should be a housing unit or maybe a leasehold interest in a housing unit or a share of the capital stock of a cooperative housing corporation where you intend to construct and own a house later. Then this property must be owned by you, either individually or as a joint owner. And then you or your family members, this would include your spouse, common law partner, your dependent children, should have lived in this property during the year in which you are going to claim it as your principal residence. And finally, you should designate this property as your principal residence. So if these 4 conditions are met, then of course your property will qualify to be the principal residence for capital gains tax purposes. Now, a question may arise that when to designate a property as your principal residence. It would be when you sell or are considered to have sold all or part of it. So it means whenever you sell your property or part of it, then you have the right that you must report whether it was your principal residence or not. You can designate for the years that you own and use it as your principal residence. However, it is not essential that you need to designate for each year when you own that property. We'll see that what are the tax implications for that in a later slide. Now, question may arise whether a husband or wife have more than one principal residence. Can they have separate residences? Well, for years before 1982, its answer is in the affirmative or yes. So before 1982, it was possible that a husband and wife could designate different principal residences for these years. But after 1982, and of course later years, there is only one principal residence for the family. That is both husband and wives. The related question may be, do you have to pay tax on gain on sale of principal residence? The answer is no. Why? Because your home is your personal use property. It is not a commercial property, for example. However, starting in 2016, what you need to do is you do have to report the sale on page 2 of Schedule 3, that is capital gains or losses in 2016. It is only for reporting purpose. You don't have to pay any tax on it. It's only for reporting purpose. Okay, another issue may be, are you allowed to claim loss on sale of your principal residence? Of course, the answer is no. Why? Because this is your personal use property. If you're not going to pay any tax on it, how can you claim any loss? A situation may arise that the property was not your principal residence for all years. Then what should be done? Then we have to follow the pro rata principle. What is this pro rata principle? For example, during the past 10 years, the property was for 5 years your principal residence, and say for 5 years it was not your principal residence. So in this case, 50% of the gain has to be reported as capital gain. It would be for those years during which it was not your principal residence. So what you need to do is, you need to complete form T2091IND and applicable sections of Schedule 3. Another situation may be that part of principal residence also used for commercial purposes. So in this case, you need to split the selling price and the adjusted cost base between the two components. And what basis could be used for this purpose? This could be square meters or the number of rooms in the property, so long as they appear to be reasonable. Then you need to report on line 138 of Schedule 3 only the gain on the part you use to produce income, because it's only on this part you're going to pay tax and not for the other part that you use for your as your personal property. Another situation could be that you're going to change all your principal residence to a rental or business property. In this case, the law gives you a choice to make an election. What this election is, that okay, although I have changed my principal residence into a rental or business property, but I am going to defer the tax payment at this point in time. Then it means that you don't have to, once you have made this election, you don't have to report any capital gain when you change its use. But once you make this election, you need to do two additional things. One is you have to report the net rental or business income you earn from this property. Of course, you have to pay income tax on it. And second is you cannot claim capital cost allowance on the property because you have not declared it as a commercial property. So CCA is not attracted in this case. Another situation could be when you are going to change your principal residence, rather your rental or business property to a principal residence. So it's the reverse of the earlier situations. So this property was basically used for your rental or business purpose. Now you're going to convert it into your principal residence. Again, you have the choice to make an election, and what this election is, it's meant to postpone reporting the disposition of your property until you actually sell it, because at this point in time you have not sold it, you simply converted its use. From commercial, it is being transferred as a principal residence. But there's a limitation to this rule. What this limitation is, it simply states that if your spouse, you or your common law partner, or a trust under which you, your spouse or common law partner is a beneficiary, has deducted capital cost allowance on the property for any tax year after 1984 and on or before the day you change its use, then of course this provision will not apply to you. You are not allowed to make this election. Another situation is that you are changing part of your principal residence to a rental or business property. In this case, we apply the substantial test principle. There are three conditions that must be met. What those conditions are? These conditions are that the business use part is relatively small. Now, what is small? It's a question of fact that may vary from case to case. Second, you have not made any structural changes in the property to get more reasonable for your commercial activity. And third condition is that no deduction of capital cost allowance on business part is made. So if these three conditions are met, then it is possible that whole property may qualify as your principal residence and you don't have to pay any tax on your capital gains. With this, today's presentation is over. For accounting and tax business management services, if you need any advice, you can send us an email at pascat2017@gmail.com, or else you can call us at 289-952-3494. Or if you're interested, you can go to our website as www.pascat.com. Thank you for your patience and your interest in our videos.